Topic 3 Asset allocation in the CAIA Level 2 curriculum focuses on portfolio construction, diversification, risk management, and strategic decision-making across traditional and alternative investments. The curriculum begins with mean variance optimization and modern portfolio theory, emphasizing the relationship between expected return, volatility, and investor utility. Candidates learn how risk aversion influences portfolio selection and how optimization techniques are applied to portfolios containing risky and risk-free assets. The material also addresses practical limitations of optimization models, including estimation error, illiquidity, and skewed return distributions. Adjustments such as liquidity penalties, factor constraints, resampling, shrinkage, and the Black-Kliderman model are introduced to improve portfolio robustness and allocation efficiency. A major section of Topic 3 examines the total portfolio approach, TPA, which challenges traditional asset class-based investing by emphasizing holistic portfolio management and factor-based decision-making. Candidates study how TPA integrates governance, capital competition, organizational culture, and risk-return analysis into a unified framework. The curriculum explains the use of reference portfolios and factor lenses to improve diversification and investment efficiency. TPA also encourages organizations to evaluate investments based on total portfolio contribution rather than isolated asset buckets. Candidates learn that successful implementation requires strong governance, long-term focus, agility, and organizational alignment, while also understanding the practical challenges institutions face when transitioning from conventional strategic asset allocation models. The curriculum further explores several portfolio construction methodologies, including core satellite investing, top-down and bottom-up allocation, risk budgeting, and factor-based investing. Risk parity receives significant attention as an alternative allocation framework emphasizing balanced risk contributions rather than traditional capital weighting. Candidates study leverage aversion theory, volatility anomalies, and criticisms of risk parity strategies. Other quantitative allocation methods such as equally weighted portfolios, inverse volatility weighting, minimum volatility portfolios, and factor-driven strategies are also analyzed. Tactical asset allocation is presented as an active approach that uses conditional forecasting, macroeconomic analysis, and technical indicators to exploit short-term market opportunities while complementing long-term strategic investment objectives. Illiquidity management represents another important component of Topic 3, especially in relation to private equity and alternative investments. Candidates learn about commitment risk, funding risk, overcommitment strategies, and liquidity rebalancing techniques. The curriculum explains how investors balance long-term illiquid commitments against liquidity requirements during periods of market stress. Liquid alternative investments are examined as vehicles offering hedge fund-like exposure with greater liquidity and regulatory oversight. Candidates also study direct investing, co-investments, secondary markets, and GP-led secondaries within private equity. The material highlights the benefits of co-investing, including lower fees and enhanced control, while emphasizing operational complexity, governance requirements, and the importance of specialized investment capabilities. Rebalancing strategies form another core area within Topic 3, demonstrating how portfolio adjustments affect risk and return over time. Candidates study buy-and-hold strategies, constant mix approaches, constant proportion portfolio insurance, CPPI, and option-based portfolio insurance, OBPI. The curriculum explains how rebalancing can capture diversification return, manage directional exposures, and respond to mean reversion or trending markets. Dynamic rebalancing approaches for illiquid assets are also explored, highlighting the complexities of maintaining target allocations in alternative portfolios. Additionally, the curriculum addresses the costs of active reallocation, including incentive fees, tax consequences, and switching costs associated with replacing managers or reallocating across alternative investment strategies. Overall, Topic 3 Asset allocation provides a comprehensive framework for constructing, managing, and rebalancing sophisticated investment portfolios in institutional and alternative investment environments. The curriculum integrates theoretical models with practical implementation challenges, emphasizing diversification, governance, liquidity management, and risk-adjusted return optimization. Candidates gain a deep understanding of modern asset allocation techniques, including factor investing, tactical allocation, risk budgeting, and total portfolio management. By combining traditional portfolio theory with alternative investment considerations, the topic prepares investment professionals to design resilient portfolios capable of navigating changing market conditions, illiquidity constraints, and evolving institutional investment objectives.